All right, traders, let's take a step back and revisit one of the fundamental concepts in options trading: call options. Imagine you're eyeing Apple stock, currently trading around $171 per share. Now let's say you're bullish on Apple's prospects and believe the stock price will rise in the near future. This is where call options come into play. A call option gives you the right, but not the obligation, to buy a specified number of shares of a stock at a predetermined price, known as the strike price, within a certain time frame. For instance, let's consider a call option contract for Apple with a strike price of $175 expiring in 1 month. If you believe Apple stock will surpass $175 within the next month, you might consider buying this call option. Now let's break down how this works. Say you purchase one call option contract for Apple at a premium of $3 per share, with each contract representing 100 shares. This means you're paying $300, 3 premium x 100 shares, for the right to buy Apple stock at $175 per share. If by the time the option expires, Apple's stock price has risen to $180 per share, your call option would be in the money. This means you can exercise your right to buy Apple stock at the lower strike price of $175 per share, even though it's trading at $180 in the market. So, by exercising your call option, you could purchase Apple shares at $175 and immediately sell them at the market price of $180, pocketing a $5 profit per share. $180 market price, $175 strike price, $3 premium paid. That's the beauty of call options. They offer the potential for significant gains if the underlying stock price moves in your favor, all while limiting your downside risk to the premium paid for the option.